Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 11th of July 2021. And one of the questions many investors are asking is, when are the central banks going to start raising interest rates? As we know what then happens. Equity markets fall and house prices potentially crash. Well, we shall deal with the latter part of this and take a brief look as to why we believe a crash in the housing market is not imminent. Now, firstly, earlier today we produced a video entitled Gold and Silver Update and Forecast for the Week Ahead, which is the same video as our weekly update with just a different title and thumbnail picture. We found that by producing two in this way enables us to reach more people as YouTube treats them separately. We plan to do this on a regular basis. So on a Saturday we'll produce our weekly update, and then on Sunday broadly the same video with just different appearances. So please, if you've listened to one, there's no need to listen to the other. Unless, of course, you enjoy doing so. Let's get back to a housing price crash potential. Now, we have to give a caveat here. There are countries around the world and states within the United States where, due to their own unique economic circumstances, house prices are either moderate or low in price, especially in areas of high unemployment and deprivation. So when we talk about house prices, we're speaking about the mean average, and not even those who've perhaps experienced a bubble or huge house price appreciation in recent years, like London or San Francisco or Manhattan, as these areas have their own unique economies and could rise or fall without the rest of the country being directly affected in the same way. Although generally there is some spin-off, because when prices go up, people cannot quite afford to live in those places, although they may work there, and therefore they have to move out to other territories. But broadly, they're quite unique positions. Now, that aside, earlier this week, Halifax Bank reported that house prices in the United Kingdom dipped 0.5% in June. And many people have asked, have house prices now peaked? Well, let's take a brief look at two articles that provide their view on what is happening in the marketplace, whether we're in a bubble or not, and defines what that is, and compares 2008-9 crash with 2021. The first article is by Yahoo Finance, which attempts to define what we mean by the term bubble and gives a motley fool conclusion as to whether we're in one or not. Let's take a quick look. Yahoo Finance article dated 8th of July. Are we in a housing bubble? In 2008, a housing bubble that had been inflating since 2004 inhaled its last breath and finally popped. And what a pop it was. The financial markets lost 30% of their value as foreclosure signs sprung up on front lawns across the country. The economy buckled under the weight of a credit crisis, mortgage crisis, banking crisis, employment crisis, and housing crisis. But things don't have to get that bad for housing bubbles to form. In fact, there's talk that the country is in one right now, or quickly moving in that direction. What is a housing bubble? A bubble forms when an already hot housing market, like the one America has been experiencing for months, becomes inflated with artificially and unsustainably high prices. It all starts when demand for housing increases and supply starts to dwindle, a dynamic that can only lead to rising prices. As inventories fall, desperate buyers start spending even more money on houses that by this point are selling well above market value. That's blood in the water for speculators who then flood the market with more money as they try to cash in on the trend. Eventually buyers give up, demand craters and prices plummet back to earth. That's when the bubble bursts. What remains is a landscape of people trapped in houses that are now worth far less than the amount of money they borrowed to pay for them, their equity negative, their mortgages underwater. How hot is the housing market right now? At the end of May, Redfin reported that more than half of America's homes were selling above list price, up from 1 in 4 just 1 year earlier. That's the mark of an incredibly hot retail estate market, one where the seller has all the leverage. A combination of factors has steered the trend. The pandemic caused policymakers to slash interest rates to historic lows, incentivizing buyers to pounce on loans that would almost certainly never be so cheap again. At the same time, renters flooded out of the congested and vulnerable cities to buy homes in the suburbs, While that was happening, millions of former office workers became telecommuters, who could now work from anywhere and move wherever they wanted. Then a lumber shortage sent the price of new home construction skyward. Fast forward to midsummer and the housing market is the hottest it's been in 20 years, breaking record after record, including record high median sale prices, record high sales above list, record high average sale to list price ratios, and record low days on the market. So is this a housing bubble? Since 2008, the term housing bubble has become a common phrase, but it's a difficult thing to nail down. Experts don't even agree on how to define the term bubble in the first place, or what criteria the market has to meet in order to be in one. The main reason that bubbles are hard to identify is that the most important component of a bubble, speculative sentiment, cannot be quantified. In the run-up to 2008, there were stories of people taking out home equity loans to buy things like jet skis and hot tubs. Home values were rising so quickly that their owners believed the lost equity would soon replace itself as the property continued to appreciate. Home values, after all, could only continue to rise. That's called speculative sentiment, and it's a key ingredient of any bubble. Fundamental forces like supply and demand determine price and value in a healthy market. When intangibles like speculative sentiment start driving prices, it's a good clue that a bubble is forming. Whilst it's true that house prices are still soaring, it appears that low supply and high demand, not speculative sentiment, are what's setting fire to the market. According to the Motley Fool, most experts do not believe the United States is currently in a housing bubble. Well, that article seems clear enough. Now we shall introduce some doubt, in that at the end of the day, whether the bubble pops or not is also determined by the action of central bankers, and we shall take a brief look at their dilemma by going to Bloomberg. Global boom in house prices becomes a dilemma for central banks. Surging house prices across much of the globe are emerging as a key test for central banks' ability to rein in their crisis support. Withdrawing stimulus too slowly risks inflating real estate further and worsening financial stability concerns in the longer term. Pulling back too hard means unsettling markets and sending property prices lower, threatening the economic recovery from the COVID-19 pandemic. So, too long, bubble gets too big. Take too stern a measure, and you could get a property crash. With memories of the global financial crisis that was triggered by a housing bust still fresh in policymakers' minds, how to keep a grip on soaring house prices is a dilemma in the forefront of deliberations as recovering growth sees such central banks discuss slow asset purchases and even raising interest rates. Federal Reserve officials who favoured tapering their bond buying program have cited rising house prices as one reason to do so. In particular, they're looking hard at the Fed's purchases of mortgage-backed securities, which some worry are stoking housing demand in an already hot market. In the coming week, central bankers in New Zealand, South Korea and Canada meet to set policy, with soaring home prices in each spurring pressure to do something to keep homes affordable for regular workers. New Zealand policymakers are battling the hottest property market in the world, according to Bloomberg Economics' Global Bubble Ranking. The central bank, which meets Wednesday, has been given another tool to tackle the issue, and its projections for the official cash rate show it's starting to rise in the second half of 2022. Facing criticism for its role in stoking house prices, Canada's central bank has been among the first from advanced economies to shift to a less expansionary policy, with another round of tapering expected at a policy decision also on Wednesday. The Bank of Korea last month warned that real estate is significantly overpriced, and the burden of household debt repayment is growing. But a worsening virus outbreak may be a more pressing concern at Thursday's policy meeting in Seoul. In its biggest strategic rethink since the creation of the euro, the European Central Bank this month raised its inflation target. And in a nod to housing pressures, officials will start considering owner-occupied housing costs in their supplementary measures of inflation. And the Bank of England last month indicated unease about the UK housing market. Norges Bank is another authority to have signalled it's worried about the effect of ultra-low rates on the housing market and the risk of a build-up of financial imbalances. The The Bank of International Settlements used its annual report released last month to warn that house prices had risen more steeply during the pandemic than fundamentals would suggest, increasing the sector's vulnerability if borrowing costs rise. And of course, those prices would rise because fewer people were selling homes, so there were fewer houses on the market, and those able to buy homes had less choice to do so, and therefore had to bid more. In addition to that, of course, companies who normally build new houses were unable to do so. And so the housing stock, rather than growing at whatever percentage pertains to each country, will have found that that level of housing dropped not just by 50%, but in some cases by 70 or 80%. While the unwinding of pandemic-era support is expected to be gradual for most central banks, how to do so without hurting mortgage holders will be a key challenge, according to Kazuo Momma, who used to be in charge of monetary policy at the Bank of Japan. Monetary policy is a blunt tool, said Momma, who now works as an economist at Mitsui Research Institute. If it is used for some specific purposes like restraining housing market activities, that could lead to other problems like overkilling the economic recovery. But not acting carries other risks. Analysis by Bloomberg Economics shows that housing markets are already exhibiting 2008-style bubble warnings, stoking warnings of financial imbalances and deepening inequality. Many economies still grapple with the virus or slow loan growth. Central bankers may look for alternatives to interest rate hikes, such as changes to loan-to-value limits or risk weighting of mortgages, so-called macroprudential policy. Now, what that basically means is rather than perhaps you being able to buy a house with, say, a 5% deposit, you may have to put down 10 or 15. So without raising interest rates, you're actually reducing the ability for people to buy houses without a greater stake from themselves. This will slow the housing market down and therefore prevent the ever-increasing prices. Yet such measures aren't guaranteed to success because other dynamics like inadequate supply, due to the fallback in new build, or government tax policies are important variables for housing too. And while ever cheap money is gushing from central banks, such measures are likely to struggle to rein in prices. The best approach would be to stop the further expansion of central bank balance sheets, according to Gunther Schnabel of Leipzig University, who is an expert on international monetary systems. As a second step, interest rates could be increased in a very slow and diligent manner over a long time period. In other words, for the banks to stop buying these mortgage-backed securities, the central banks, that is. Another possibility is that house prices reach a natural plateau. UK house prices, for example, fell for the first time in 5 months in June, a sign that the property market may have lost momentum as a tax incentive was due to come to an end. There's no sign of that in the US, though, where demand for homes remains strong despite record high prices. Pending home sales increased across all US regions in May, with the Northeast and West posting the largest gains. While navigating the housing boom won't be easy for central banks, it may not be too late to ward off the next crisis. Owner-occupier demand versus speculative buying remains a strong driver of growth. Now, what that means basically is rather than people buying houses in order to flip them because they see prices rising, they are also claiming that actually people do want to move into new houses. And what we found certainly in the UK is that because of the rising prices, people are living with parents longer simply because they cannot afford the houses until they've raised a sufficient deposit, which could take years in an environment where wages have only been rising very slowly. Banks aren't showing signs of the kind of loose lending that preceded the global financial crisis, according to James Pomeroy, a global economist at HSBC Holdings. If house prices are rising due to a shift in supply versus demand, which the pandemic has created due to more remote working and people wanting more space, it may not trigger a crisis in the same way as previous housing booms, said Pomeroy. The problem may arise further down the line, with younger people priced out of the property ladder even more. As they tiptoe away from their crisis settings, monetary authorities in economies with heavily indebted households will need to be especially careful, said Alicia Garcia Herrero, chief economist for Asia Pacific at Natixis, who used to work for the ECB and International Monetary Fund. Real estate prices, as with other asset prices, will continue to balloon as long as global liquidity remains so ample, she said. But the implications are much more severe than other asset prices, as they affect households much more widely. Well, the conclusion from this is that caution has to be maintained, and much now depends upon the speed of global economic recovery, whether employment numbers improve or not, and the policies central banks adopt in terms of loose or less loose monetary lending. Our thoughts are that before we see a rise in interest rates, other measures will be adopted to calm the housing market down. Higher loan-to-values, new low-cost and social housing projects encouraged, and central banks cutting back on their outright purchases of mortgage-backed assets or securities. Governmental taxation policies incurring additional charges on second home ownership and changes in capital gains tax rates on the sale of investment properties also have been or can be introduced to calm the froth, so to speak. In conclusion, with a few exceptional areas which are unique, we do not foresee a bubble burst or housing crash anytime soon. What we do see is a gradual deflation or a slower inflation in house prices moving forward by some, if not all, of the techniques already mentioned, and even more that perhaps we've not thought about or covered. What do you think? Do you agree with us or disagree? Do share your thoughts. Meanwhile, we'd appreciate it if you would give this video a thumbs up, subscribe if you haven't done so, press the bell sign, and also go over to our Crypto Plus channel, where we're interviewing Nikki today and discussing an update on her portfolio. And that should appear in the next few hours. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.